everyone, welcome to the REIN channel and this Ask segment, always seeking knowledge. Today, I am joined by a trusted partner, longtime REIN member, a big part of this community over many, many years, George Duby with BDO, accounting extraordinaire. George, thanks for joining me.
Thank you. I always love the introduction of accounting extraordinaire. That sets off my day for me. Thank you.
Because it's just true. The man, the myth, the legend, BDO and accounting when it comes to real estate and looking after the community is off the charts good. So we got a couple of topics that we want to cover on today. Maybe even throw in a bonus topic. But the one thing that we want to talk about and hit on, because we've been asked about it, is what is going on with the underused housing tax, number one. Number two, I have a question for you around tax time and what is the best way to set up our year ends if we have a corporation. And I'll save the third bonus kind of segment until we get there. So listen and follow along. And George, let's start with the underused housing tax. What is the update? What do we need to know? What's going on?
Well, and again, this is something that seems like every time we approach a deadline or something, there's a new rule that spices things up or what have you. The fortunate part is that they're actually in our favor this last couple of times. And so what's happened is that Revenue Canada, I think, has taken a look at some of the filings that they have received and realized, oh, we actually have to look at this stuff. And it's not very automated at this point in time. And so I expect just overwhelmed and realize, okay, the vast majority of this stuff has zeros on it. It's a complete waste of time. We are going to not change the rules for 2022, but for 2023, which filing is coming up for April 30th, 2024. But the 2023 rules, they're probably going to be, I don't know the exact percentage. I'm making this number up, but I'm going to suggest that roughly 98% of our clients, REIN members, are not going to have to file for the UHT returns any longer. Because beforehand, what was snagging people is if they had a trust, they had a corporation, they had a variety of different scenarios, bare trusts and partnerships. They were getting caught up in the rules, despite the fact that the final answer was zero. And so now Revenue Canada is saying, or expanding the eligibility for, and I guess I should just toss out there to have to approve it still, but most likely it's going to go through. And that's to say, if we're using corporations and trusts and partnerships where there are no non-residents involved, non-citizens, etc., then we're likely going to be able to not file. So again, fantastic news. So most people begrudgingly were taking time to do that last year. And we thought, okay, at least if once we did it, we were going to, forgive the expression, but kind of copy and paste into next year. Well, probably now it's not even worrying about that. We're just going to toss it all out in the garbage, which is good for most REIN members.
Perfect. So, in other words, if I'm hearing you right, there's really much ado about nothing when it comes to the underused housing tax. It is kind of, I don't want to say fizzled out, but it's not as big a deal as it was when it's initially presented. Is that a fair statement, George?
It's a fair statement. Now, perhaps what the issue is, in my mind, Patrick, is that now perhaps is more dangerous in the sense that very few of us are going to be thinking about it because, oh yeah, most people don't have to worry about it. But if you do have to worry about it, it's a slam. They did decrease the minimum penalties, or they're proposing to decrease those minimum penalties. If you recall, they started off with the original legislation of $5,000 or 10,000, depending if it's personal or corporate. That's a pretty big kick in the ankle, if not somewhere higher, where we're just starting off and in most cases, probably quite innocently missed a deadline or didn't understand we had to file. So again, the changes to 1 or 2,000, which are still high, but at least it's better.
Beautiful. Okay, are we ready to move on? I think that pretty much
We are.
covers that topic. Are we good?
I'm good.
I'm good. I think our listeners will be good. I think it's pretty straightforward in that regard. Something that you brought up, and I'm going to make this my bonus third before I get into, how do we structure our corporate year ends and some thought processes around that, only because you mentioned it. Can you give me some and our listeners some insights into, we hear the term often, bear trust, and what the heck is a bear trust? Why do I want to be interested in it? Why do I even want to consider using a bear trust? Can you kind of give us an overview and unpack that a little bit?
Absolutely. So the majority of real estate investors will see a bare trust. And I'm not sure exactly what the technical definition is, but we're going to go with the George definition. And we're going to say, describe that as we it often comes about from a financing perspective or a joint venture perspective in the real estate context. And so I'll give two examples, I guess. One is to say I have a corporation and I find it easier to get financing in personal name as compared to corporate name, perhaps. And so a lot of individuals will say, will have legal title in their personal name, and they will have beneficial interest, or the beneficiary, if you will, is going to be the corporation. So they have a bare trust in that they are holding the property on behalf of somebody else, in this case, a corporation. And really, from an income tax perspective, up until very, very recently, we rarely cared from a tax perspective because bare trust, up until very recently, didn't have to file returns. There was no activity because anything that I did as a bare trustee was on behalf of an individual or a corporation. And so they would record whatever it was in terms of profit losses, etc. The other common example then for real estate investors is that joint venture where one of the individuals perhaps is more credit worthy, better on a title, for example, for financing purposes, and there's a multitude of different reasons for that. They'll be on title, but they have an agreement with you and I, Patrick, to say they're going to hold title for us, and you have 25%, I have 25%, they have 50. And so then that's going to again be a bare trust where you and I are not on title, they're on title. And
Mhm.
one area, if I can, I'll just mention as well that from a non-real estate perspective, that can affect real estate investors, or for that matter, anybody. And I think this is the ones that's going to snag a lot of people. It will be where maybe our name is on, for example, an investment account, a liquid investment account, a bank account for dear old mom and dad, or perhaps minor children, for example. And so we may be in a scenario where there's a bare trust because we probably don't have any specific, we have signing authority, for example, but we're really not the owners. We're just taking care of mom and dad or the kids. And so now that's a bare trust, which will be required. Well, I'll just leave it at that. That can be a bare trust, which again, from an income tax perspective, generally speaking, we really didn't pay a lot of attention to because as long as it was done correctly, there was no harm, no foul.
So George, when we look at a bear trust, let's talk about, let's break it down a little bit. When we say, okay, so what is the advantage of having a bear trust? Let's answer that question. Is it strictly I guess a tax thing where we get to maybe save on some tax consequences? Is there some risk mitigation that's within the strategy of a bear trust? And I'm curious, based on what you said there, how does that land for the bank? So, in the context of those three questions, can we just touch on each one of those and uh, let it go where it goes? But certainly,
Sure.
I think those are three good ones.
Yeah. So if I can, I'll start on the tax side, and it's to say there's really not, normally speaking, a tax reason to set up a bear trust,
Mhm.
um, other than it allowing, for example, if somebody comes to me and I'm saying, hey, I really would like you to own some real estate in a corporation, but they're saying they can't do that from a financing perspective. Well, that bare trust may be a tool that we can use to get there and kind of
Mhm.
solve both problems. But the real problem that I'm just describing is more of what I would call a financing issue,
Hmm.
and where we're dealing with dear old mom and dad, it may be more of a practical issue in the sense of taking care of them, or our kids, minor children, um, and just being
Yeah.
able to execute documents on their behalf or with them. And some people will use it, again, depending on the province. So some provinces, it's really not a big deal at all. You come over to Ontario as an example, though, and probate fees, and I know I'm not giving it the technically correct term, estate administration tax, I think is what it's called, but whatever the specific province is going to call those.
Yeah.
Um, well, it's possible when it's set up correctly that we can avoid that probate fee. And if those probate fees are kind of 1%, 1.5%, 2%, well, there's a value there to escaping that. There's also thought process in my mind: don't screw anything up because it's only 2%. But
Hmm.
again, that's a side topic. But a lot of people are interested in that, or trying to address kind of the financing issues, practical issues in dealing with minor children or aging folks, and then as well getting into the, again, I'll call it a tool, from being able to do whatever it is you're looking for from an investment. I guess, and that maybe is another description too, where we're using a joint venture. There's kind of an investment deal that we're trying to set up with the property. So again,
Hmm.
that bare trust is more of probably a tool used as compared to anything else, because it really doesn't have tax implications directly. It's that it allows us to do other things.
Hmm. Got it. So one question around that when we talk about a bear trust, and this is I think something that many have expectations around what this tool will do. I'm curious from your, based on your experience and talking to so many clients around this particular strategy or using this tool, does it add a wrinkle of complication when it comes to getting financing, or does it actually help? So, in other words, in all scenarios, I'm guiding investors all the time to work with a mortgage broker, an investor focused mortgage broker, as opposed to going to the bank. So, in this particular scenario, if I'm dealing with an investor focused mortgage broker, I'm going to mention Bear Trust and suggest that that's what I'm considering, given partners, etc. They're going to say, got it. I'll work within those parameters, that framework. I know the banks that are, easier to work with in this case. But if I'm going to the bank, and I say, no, I'm going to take the path of least resistance. I'm going to go deal with whatever one of the big five banks are. So, in that kind of context that I'm providing, is there wrinkles that get created by having a bare trust?
I think the wrinkle is not, and I won't pretend to be a legal expert in the slightest or anything, but I mean,
Hmm.
you and I have been enough
Let's not
around
pretend that.
enough
Yeah,
real
let's
estate
not pretend
deals to,
that.
yeah, just to say, okay, if there's not a disclosure to the financial institution that a bear trust in existence, um,
Mhm,
they're going to get the shorts and a knot.
mhm.
And then we have the, as I understand it, risk of them saying, "Hey, wait a minute, you weren't playing fair with us. You haven't
Yeah.
disclosed." We
Yeah.
have the ability then to call the loan, or the
Mhm.
mortgage. And so all of a sudden, while I appreciate they may rarely do that, there's a difference between they may rarely do it and they did do it.
Yeah.
And if you're one of those people, then all of a sudden, oh my goodness, that was quite the shock, I'm sure, because I expected it says something to the effect of, you have 30 days or some other short period of time to all of a sudden provide alternative financing. And heaven forbid that, I had a handful of properties that I did that and didn't disclose it appropriately. I'm in a world of hurt for there a little bit of time,
Mhm.
I expect. And so I think people can get themselves into trouble. Do they
Yeah.
frequently? No, I don't think so. Is it theoretically possible? Yes.
Well, it's interesting topic, and we won't go off it too much because, certainly what happened through the boom of 2021, 2022, there was a lot of mortgage fraud. There was a lot of non-disclosure of particular details to the banks, and I'm not suggesting that not disclosing this to the bank would be fraud, but to your point, it's better to disclose than have something, come back to haunt you. And any good mortgage broker will actually guide you in that regard anyway. So you're always going to disclose to your mortgage broker ultimately that's where you got to go with it. Now, just in engaging and using this tool called the Bear Trust, where does that start? So I have this thought, I've got this deal, I've got these partners, I've got mom and dad, whatever the scenario is. Where am I starting this conversation? Am I going to legal counsel, or am I going to George with BDO and going, George, here's my thoughts. What should I do? Where do I start that process, George?
It can start in different places. So it certainly frequently starts with George,
Hmm.
or one of my team. It often frequently starts as well with some of the mortgage brokers that really know what they're doing
Ah,
on the real estate side. Um, the
so
lawyers
there's a
often won't.
suggestion.
Yeah, the lawyers often don't really get super involved with it, at least
Yeah,
initially. Or again, and if somebody's going in there with the intention of not disclosing, they're not going to be able to disclose it to their lawyer handling the real estate transaction, because they're going to, as I understand it, have a duty to disclose to the financial institution. So now all of a sudden
100%.
you have to rope in a second law firm
Yeah.
and create the actual Bear Trust agreement. So now we're start
Mhm.
like when you have to start using a separate law firm and you can't tell your lawyer something doesn't seem quite the way it should be.
What's interesting is, I just want to wind this segment up on one particular note, which is, I see a lot, especially these days, with there's investors and there's speculators, and those bad investors are doing this, and those speculators have done that. And there's a lot of conversation around that. When I look at real estate investing, and George, you've been part of this community for 20 plus years, and understand that as investors, quote unquote, we're actually small business owners. Even if we own one piece of real estate, treat it like a business and things will go far better. This happens to be a strategy, a tool that we can use. We talked a little bit about, how you engage with your mortgage broker, with your accountant. If you treat it like a business, then it kind of takes the investor or speculator component right out of the equation. As much as, yes, I own businesses, so I look at that and I go, okay, am I a business owner, or am I an investor? I've got a business that I'm not in day to day in any way, shape, or form. To
Right.
me, it's a business, but it's also an investment. It's an annuity that is paying me and will pay me for many years to come. And that's how I look at real estate. It is a business. And if we look at it that way, we make different sets of decisions. So I don't want to
Mhm.
beat it to death, but I think, when we look at the tools of a Bear Trust and having the right people on the team and using that tool, seek the guidance, to your point, of a mortgage broker, disclose what's going on, have a conversation with your accountant, and eventually legal counsel to bring that together. Now,
And just as a real quick, maybe I
yeah,
shouldn't do this, but what
please.
I'd like to have, and what I've told different people, is try and have at least an email with the broker or whatever, showing, "Hey, I'm putting this Bear Trust in, I'm
Mm,
disclosing it to you," type of thing. Just so
mhm,
if the bank ever does come back and something, because I think there's a variety. Well, we've seen in the media where there'll be people at the financial institution, for example, not fully disclosing to their superiors
yeah,
what's going on. At least let's protect ourselves and say, "Hey, I tried to disclose it.
yeah.
I mean, I don't understand all this paperwork maybe, but I put in plain English, here's what's going on." So, I mean, I'm sure there's still probably repercussions, but at least I think it's to have a different type of
Yeah.
a different discussion with the bank in terms of remedial
I
action,
think,
for example.
and I think, George, I think that's just a great point. It's a little bit of CYA, may
Yes.
seem overdone, but there's no downside to doing that. There is a
Right.
downside to not doing that, perhaps, maybe. So it's always better. When you look at risk mitigation, you look at risk reward, there's no downside to just doing a little bit of CYA in that regard. I appreciate you bringing that up. That's great. Now, we talk about treating things like a business. We look at tools and strategies and accounting, legal counsel, mortgages, all of the stuff. We got a lot on our plate. Whether you own one door or 100 doors or 10 doors, doesn't matter. You got a lot of things going on, lots of paperwork, and there's some responsibility that comes with that in treating it like a business, which is to say, at some point, we have a year end. Now, whether that year end is a corporate year end or not a corporate year end, we have to assign a year end that makes sense for us. And that may not necessarily be December 31st of any given year. When we talk about year ends, what's your strategy around that? So for me, I have a number of corporations. I've got a couple that are year end December 31st, and then I've got a couple that are kind of the end of March. I've got one or two that are the end of May, and they're staggered. Now, I staggered them for a number of reasons, not the least of which is just the overall workload of bookkeepers and me having to bring all the final paperwork together and my
Right.
irritation with any of it, by the way. Having said all of that, what's your guidance as the expert on this panel of two?
So what I like to do is have the discussion in the sense of, okay, let's go through some of the choices. And so, absent a regulatory requirement, so for example, my professional company where I practice accounting from, I'm required to have a December 31st year end. And there's it's not per se that component to it. The
Mm-hmm.
component is because I'm a corporate member of a partnership. So I don't have any practical choice. Um, so there'll certainly be a small percentage of those. The natural thing, of course, is to use a calendar year end as the year end. And what I like to just quickly walk through with people is to say, well, from an income tax perspective, that's probably just about the worst year end to pick. And my thought process is in a couple different ways. So one is by the time you have all your bookkeeping up to date and everything's ready to go, you're probably 30-ish days after year end. So now let's say we're at the end of January. Well, now we have an issue where we're getting into deadline reporting items such as T4s and T5s, which are required at the end of February.
Mm-hmm.
And so if it's going to take your accounting office, again, 4 to 8 weeks to kind of put together the financial statements, tax returns, do the whole shooting match. If everything goes perfectly, they're going to have the information available to them to make the perfect decision for what that T4 or T5 should look like. The odds of everything, of course, being perfect, extremely close to zero. And that means the accountant is going to be making, I'm going to call it an estimate. It's not a guess, and it's probably a really, really good estimate, but it's not going to have the perfect hindsight we'd otherwise like to have.
Mm-hmm.
It's also a time of the year where the accounting offices are getting busier and busier as kind of mid-January hits, and as they hit their peak, typically around April 30th. Well, the accounting offices can handle it usually in that they're going to hire more people for that period of time. But are you really getting the quality time with George, for example, or whomever at that point? And it's not that George doesn't have some quality time to give, but they're shorter time frames. So now the other aspect of that is kind of getting things ready. Um, well, maybe we should look at kind of September, October, November, for example. Well, now let's keep in mind corporate deadlines. And so taxes owing for most real estate investors are going to be 2 months after the year end. It's possible it's 3 months in certain cases. And so if we're looking at an October year end, that means for December 31st, our taxes, if we don't want to pay any interest, are going to be due. The tax returns due 6 months later. So we got lots of time for that. But if we're concerned about paying some extra interest, we have to have it for December 31st. And again, I don't think our accounting office or ones I've been involved with are unique in the country in the sense of you can shoot a cannon through our office in the last half of December and there's little collateral damage. It just
Yeah.
everybody wants to do some vacation time. They
Yeah.
want to be with friends, family, etc. And so whether it's your on the financing side, the accounting, the legal, well, wait a minute, you may have a life too, and want to be doing anything other than thinking about accounting. And so I try and stay clear then from kind of that September through December time period, unless I really have to, or there's some exceptional reason to do that. So then I start looking at, okay, what time of the year is it? So if it's, for example, you come into my office today wanting to set up a corporation, I've just asked kind of that September to December if you're going to pay attention to me. And so now maybe let's say I took January 31st. And so today being kind of mid January is our example. Well, that means I'm going to have to do a full set of financial statements and tax returns for basically kind of a half a month. Or if we took April 30th, well, it means I got 2 or 3, depending on the time of the year, I've got that
Mhm.
short period of time before I have to get that a full set, and it's not prorated the cost of financial statements and tax returns. Just because you only had 3 months there, it doesn't mean you had 3/12 of an accounting invoice. You got the pleasure of the whole thing, and so you really didn't get much bang for your buck. Now, if you already had 3 or 4 companies that had an April year end and you're trying to tie it all in together, sure, it's a one-time cost. It makes sense. But if it's our first go around, maybe I should use July or August, for example. And that means, yeah, it's not the full 12 months, but I really don't want the pain of dealing with an October, December year end, for example, on an annual basis. So I take it in the shins a little bit for that first year. It is what it is.
Mhm.
But so again, a handful of different things. Part of it's a seasonality too. So as real estate investors, we probably really don't care what time of the year it is for a large degree. Whereas
Mhm.
if my main business was cutting grass, well, I don't want it the year end in July. I
No.
probably want it at the beginning or the end of my season,
Mhm.
and tie things in there. The other thing to consider is if I'm using my corporation in a real estate context and I have a lot of joint ventures, maybe I still want December 31st, despite what I've just said, because all my personal co-ventures are going to want calendar year reporting. And it's just
Yeah.
easier to get it all together at the same time, send it out. It just, I mean, there's disadvantages, obviously, but there's a huge advantage of keeping other people happy and wanting to invest more with us on future properties. So again,
Beautiful.
it, there's going to be pros and cons to different times.
Yeah.
I find probably 90-ish% of the clients are happy with kind of summer year ends, for the lack of
Yeah.
spring, summer, early fall. You make a great point too in terms of the staggering of the year end. So pros and cons with that. So mine are staggered, admittedly, because like you, I've got probably a few too many entities kicking around, and there's the practical issue of dealing with them all at the same time.
Yeah.
But normally, we like to see the year ends all on the same date, in that it makes the reconciliations between companies. So if we're transferring money from company
Mhm.
A to B to D to back over here, it's just
Good point.
easier to go bang, let's take
Yeah.
the photo, if you will, and force it all to reconcile. Whereas if it's off by a month here or there, we probably aren't necessarily doing as great of a job as we should be in terms of making sure it all fits together properly. But
Yeah.
I agree with you. Like, if you got so many companies kicking around, it's a practical issue.
Well, I think there's a couple things around it, and we don't need to beat it to death. I think the main point in all of this is that it's not a written in stone December 31st kind of year end. Is the first and foremost. I mean, to in our situation and in many investor situation, you have more than one corporation, and you may have corporations as in holding companies, and then you may have one or two operating companies, depending on what it is that you're doing. All of which, from my perspective, your accountant needs to bring together. And to your point, given the timing of transfers from one corporation to another and the reasons for doing that, there is a reconciliation that comes into play in terms of your decisions of when you're going to have those year ends. So George, I'm going to end it here and say thank you for the expertise and the support that you bring the community. I think there's just some real wisdom in all of the stuff that you bring. And the wisdom is really in the practicality of bringing these things together and having conversations with them. You do a brilliant job of that. I want to say thanks. And listen, everybody, if you're looking for a great accounting team, George and his team with BDO, they're expansive, they're extensive, they're experienced, and they cover a lot of, I guess, topics, in that you've got a pretty wide bench, from taxes to HST to GST to corporate tax and real estate. You do it all, and you've got the team and the bench to do that. So thanks again for all of your support and all your time, George.
Thank you. And again, as always, it's a huge privilege to be part of the REIN group.
Thanks, Ben.
Thank you.